Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. We have lots in store for you, but we're going to get to the stories first that we're following in the BNN Bloomberg newsroom. G7 energy ministers met earlier today to discuss a possible release of oil reserves to stabilize markets. The countries have instructed the International Energy Agency to assess the situation and be ready to potentially release emergency reserves should the need arise. The agency is exploring scenarios and is set to hold a meeting later today. Shares of Go Easy are plunging today. Look at that, off by more than 58%. The alternative financial services company withdrawing its 2025 outlook, 3-year forecast, and also suspending share buybacks and dividends until further notice. Go Easy says it also expects pressure on charge-offs as well as higher delinquency reporting to continue over the coming quarters. Improvement is expected in 2027. We're also watching shares of Air Transat. Shareholders of the Canadian airline have rejected the new slate of board members proposed by billionaire Pierre-Carl Pelado. His proposal would have given him partial control of the board. In December, Pelado proposed cutting the board to 6 directors, citing shareholder value destruction and a broken balance sheet. None of his nominees were elected, and investors also voted against shrinking the board. Taking a look at the markets right now, and still in the green today. Investors looking for some safe havens right now, trying to figure out their next move. The TSX up by 0.75 point roughly, and south of the border, U.S. markets also in the green right now. S&P 500 up by about 0.5, the Dow by 0.65, and the Nasdaq by 0.7. Of course, all of this tying in with oil prices in retreat today after U.S. President Donald Trump said the war in Iran could end soon. G7 energy ministers, of course, talking to potentially release oil reserves. And here to break this all down and the big market trends for today, Scott Ladner, CIO at Horizon Investments. Scott, thanks very much for joining us.
Hey, Roger. Nice to be here.
All right, we're getting a little bit of an idea from the G7 energy ministers to maybe release some oil. What do you think is going to be the next step?
Yeah, look, this is probably a helpful first step. This is obviously, the impact for this conflict is wider than the Ukraine conflict that we saw a few years ago. It's having a wider impact on oil prices and energy prices, broadly speaking. So this isn't, it's not just a European problem this go around. This is really kind of a global energy problem that we've got if the Strait of Hormuz is going to be closed. So it makes some sense to have some global coordination to counteract some of those effects, even though it's not going to last forever. It should help on the margin.
Should we be reading into it that they're even contemplating it? Does it look like that they're maybe thinking this could go on for a while?
I just think they're trying to bridge a gap here, Raj. I mean, this is not a situation where it's likely going to be solved in terms of the actual conflict. In a matter of hours or days. It's probably going to go weeks, hopefully not months, but certainly could go weeks. And strategic oil reserves are here for a reason. Countries have them for a reason, and the reason is to kind of overcome short-term supply disruptions, like hopefully is what we've got on our hands right now. So it's probably a pretty smart move by the global energy community.
Is weeks manageable, or how long do we have before this? This is obviously a concern, but how this becomes a real concern, maybe global recession, things like that.
I think this is obviously one of the big points that we're trying to figure out. The time under conflict, frankly, is the metric that we're really kind of thinking about in terms of defining, how important this is going to be towards global growth and for sort of the inflationary impact that this, something like this might cover. But we think if we stay under, call it 8 to 10 weeks, we're probably okay. There's probably going to be a blip rather than something that's more sort of like nasty and long term. But if we get into like measuring this thing in terms of 2, 3, 4 months. Then we're probably talking about something a little bit more serious in terms of the damage it's going to end up doing to global growth. We don't think that's going to be the base case right now, but we are not geopolitical experts here. We are sort of reading and reacting like the rest of the world.
And that time under conflict, does that include ships starting to move through the Strait of Hormuz, or
absolutely? That is the most important thing to be watching. And I think I put in my notes, like, everybody's going to become a satellite expert here in the coming days. We're all going to be looking at satellite images, seeing if we're getting some of this movement of ships through the strait. That will be the physical embodiment of the conflict lessening. Right now there aren't any ships moving through, and so if we get visual evidence of some of this stuff starting to happen, that'll be a massively important milestone in this. And how this conflict is proceeding.
Yeah, and now we heard that like a Greek tanker may have got through, was running oil to India as a possible report, but nothing else has moved, at all.
Yeah, and that is obviously the thing that everybody's watching for. And I don't know that anybody's really got an edge towards predicting some of these things, but watching it, and sort of listening to some of the rhetoric, and then watching the action on the ground and the action in the strait, really would be determinative of how long this thing might really impact oil prices in a bad way.
And now Saudi Arabia has managed to move oil through their pipeline to the north. Could that be a realistic route, or is there just too much oil to move on a regular basis?
There's too much oil. I mean, we need ships, large ships and large container ships moving oil through the strait. Like, that really is, sort of the bottleneck that everybody knows about. This has been a bottleneck here for as long as really like oil has been a big deal in the Middle East. This is one of the known sort of constraints and one of the known risks towards the geographical area around there. And pipelines can't really get the job done. It'll help, but it is not going to be sort of determinative of making oil prices go down in a way that would be really meaningful for the global economy.
Yeah, now we're seeing, oil has dropped. I think last time I saw it was at 85, but that was like an hour ago. What's it at now? It's at 80 now. So it's dropped another, holy cow, it's down 15%. Is that realistic, or are we going to see it go back up again?
Look, I wish I had the crystal ball to answer that.
I don't
question.
have one, so that's why I'm asking if you have a crystal ball. I'm not even going to guess.
Prices matter, and price movements, especially when we're seeing something this big, matter, especially coming off like the blow off top that we had in oil over Sunday night. I mean, everybody's looking at $120 oil, and now we're sitting here right now looking at these live ticks going, with 80, hopefully going under 80 here pretty soon. That's a massive move over just a couple of days, and so that you don't get that kind of price movements without something really mattering or something really moving. So I do think you can read from prices into actual activity, but look, we are going to have to just watch this thing, and it is not going to be not volatile for a little while. It is, this is the world that we're going to live in for at least next few days and probably weeks.
Sorry, I don't mean to laugh, but that does seem to be the word of the day, doesn't it? Volatile, and trying to predict next. I mean, gold, would have thought gold, we'd see more of a spike, and it really hasn't spiked as people try to figure out where to put their money.
Yeah. Okay. One thing that I think has come out of this is that the recognition that gold has become much more memey. It is really the performance of it this year, really the last couple of years, has really attracted a lot of retail assets, a lot of retail money, a lot of fast money, frankly, from the kind of the if you just think about it, like the Wall Street bets crowd, and that has made that's changed the nature of like what gold can do in a portfolio. It is a risk-on asset right now. It is not necessarily a hedge against geopolitical risks. It's not necessarily a hedge against inflation. It is really more of a risk-on memey type of asset, and we're seeing that in the performance. Gold being down a couple percent with oil being up 40 is not the sort of outcome that you would have expected to see even 6 months ago.
And bonds, same situation, isn't it?
Yeah, bonds are interesting, right? I mean, at least in the U.S., rates are up, 10 or 20 basis points across the curve, and that's telling you that the market is not thinking this is a big growth hit right now. If this is being seen as a big growth hit, you see bond yields down dramatically, not up 10 or 20 basis points. And so that is one read through that is pretty clear from the bond market into the broader economy. That this is seen right now as being more of a blip in oil prices and more of a blip in global growth and inflationary pressures, but nothing that's really going to be sort of long-term dramatic that would force the hand of any central bank around the world.
And I was going to say, we're almost out of time, but where does this leave the Fed, do you think?
This leaves the Fed on hold. There's something, one line we've been using as a boring Fed is a good Fed in the United States. We think, this just takes cuts, frankly, probably off the table for the next few meetings. But that's not ultimately a really bad thing. It's if the Fed's, the worst thing coming out of this is the Fed stands pat in 2026. That'll end up being a pretty strong thing for equity markets, I think, throughout the rest of the year.
Okay, we got to wrap it up there. But Scott, thanks very much for joining us.
Appreciate it.
Scott Ladner, CIO at Horizon Investments. When we come back, we'll take a look at today's trending trades. All right, let's see what's trending today. There are a few things to talk about. First up, we'll talk about some TSX leaders. Energy fuels is up. Not much fueling that right now. No real news of note. I was just taking a look. It's just up. No greater than average number of stories they have on it, but you can see it's up by 6.5%. Pan American Silver as well. Same thing. It is up about 3.3%. Ave Maria Value Focus Fund actually reduced its Pan American Silver Core, announcing that today. So they're still up about 3.4%. Lundin Mining up nicely right now, up about 5.5%. It announced it has acquired a 5% ownership in Caserones, 31% in the Los Haldados project. And going the other way, go easy. Oy, oy, oy. It is down nearly 60. It was down 60% at one point. It's recovered slightly. That's a relative term. 58% right now is what it's off by. That's because it's pulled its previous outlook, 3-year forecast, suspended dividends. CGI is down as well. CGI is the next one we want to talk about. Yeah, Go Easy is not having a good day. And CGI just announced it's partnering with the Finnish Meteorological Institute. And I guess people don't like that. They don't like the Finns. I don't know. It's up by 2.2%. Some other movers to mention. Air Transat. It is off about 1%. It's Q1 revenue beating. And another one to look at, Fairfax. Up about 1%. Not a lot moving right now, but selling a stake in Poseidon. I guess that's making some people happy about that. Well, Qantas is hiking international fares about 5% as jet fuel prices spike on Middle East tensions. Savanthi Sith, airline's managing director at Raymond James, joined Bloomberg Open Interest to discuss the stress points in the airline industry as the war upends travel.
Each airline is different. A lot of U.S. airlines actually do not hedge. Hedging is a very expensive insurance policy, and there are other tools that airlines have, kind of good balance sheets, margins to try and kind of work around it. And the best kind of tool that they have is capacity and fare increases. In Europe, you have a lot of airlines that are hedged because it is very hyper seasonal. But you're right, the airlines sell 2, 3, 6 months ahead of time, and sometimes it helps to kind of hedge what you're going to be flying. But a lot of airlines are kind of open to the fuel price increase, and this level of increase is really tough to overnight pass through. So airlines have to start right now.
It might be worse in Asia. Matt and I were looking at a story this morning that Qantas is looking at raising their ticket prices in reaction to what's happening with fuel prices, that Air New Zealand might be shortly behind. Is this something the American air operators can do too? Do they have the room to raise prices in reaction to what we've seen over the past week?
Yeah, we're hearing that some U.S. airlines are already trying to increase prices. I mean, definitely, if you think about the Strait of Hormuz and which regions are more impacted, it's definitely a bigger impact on Asia. But it is raising prices. Jet fuel is a global product. It is raising prices for everybody. And you have U.S. airlines that are already trying to raise prices as well. And to your point, it's such a big move that they have to raise prices.
For some reason, Savi, I'm interested in incremental moves in oil and how that affects other outputs. So do you look at that, like if jet fuel moves in a $10 band, how that affects earnings at a specific company?
Yeah, I guess the easiest way to kind of think about it is, look, fuel is going to be anywhere between a fifth to, for some airlines, it's 40% of costs. And so that is a significant hit. Now, you're looking at, the type of moves that we've had right now, you're looking as much as 10 points of margin that has been wiped out once all of this flows in through the P&L. So you really have to kind of raise fares by, 10% or more to at least kind of start making a dent in all of this.
And the fuel prices, to be clear, Savi, they move on an amplified scale compared to Brent, right? If we see Brent go up $10 and that's a 15% move, you could see jet fuel rise 40, 50, 80%.
Sometimes it really depends on the refining, how many, if the refiners are down or not. And that's definitely what we've seen. So the move in jet fuel has been greater than the move in Brent in a lot of cases, as some of the refiners are getting shut down as well. So this is, you're exactly right. It's been a much bigger move in terms of the impact to jet fuel.
Savi, I know Delta owns a refinery itself. Does that airline emerge much less scathed, much more unscathed than its peers?
Yeah, so hedging is one method to kind of get, just doing swaps or caps, contracts like that. Delta does own a refinery. You're exactly right, Danny. That should help them, at least on the refining margin. They are exposed to crude price increases, but on the refining margin, they should be able to offset some of that increase. It's still a negative impact overall, but it should be less at Delta.
I think one of the biggest concerns for economists is if we see this persist, and I know that, higher price sustainability is key, you could see airlines reduce their aircraft purchases, right? I mean, would be, for an economist looking at GDP, the biggest fear. Do you see that as a possibility?
It really depends, Matt, on how long this lasts. If this is a short-term spike, then I don't think you're going to see any kind of change in CapEx. It is not as easy to work with the OEMs, especially for aircraft that's being delivered this year and maybe even to next year. But the longer-dated aircraft can get pushed out. What happens immediately is you start parking the aircraft that you have. You start flying them less, and you take seats out of the market, and that pushes kind of pressure on the fares immediately. So that's what I think what you see first. First, you start to see kind of the maintenance providers getting hit. And then longer term, if this fuel price persists, then you will see kind of order books getting narrowed.
Hey, Savi, real quickly here, because we're almost out of time. The DHS and the partial government shutdown has now entered its fourth week. TSA agents are now starting to miss their full paycheck. Is that having any impact on these airlines with these long lines at TSA with demand?
So far, we haven't seen an impact on bookings, but it is definitely a concern. I mean, this is a kind of bipartisan political failure that we're seeing here, and hopefully this gets resolved. But it's happening at a time that this is peak spring break period, and so hopefully this will get resolved soon. Right now, we're not seeing it as an impact on demand, but clearly, the longer this goes, it is a big concern.
Coming up, hot picks in big tech, and we'll get more on the rotation out of tech stocks following the Iran attack last week. Stay with us. All right, time for hot picks in big tech. We were joined earlier by Jed Ellerbrook, portfolio manager at Argent Capital Management, to discuss what he calls outstanding earnings and outlook, and started off with NVIDIA as his top pick.
I thought NVIDIA's earnings were outstanding last week. Couldn't ask for more. Stock did not respond very positively to that news, and the stock has underperformed, really for 6 or 7 months now. I think the valuation is attractive. I think the company's growth prospects are really strong. Morgan Stanley had their big tech conference out in San Francisco last week, and I think the biggest takeaway for me from that event was just the overwhelming demand for computing power. NVIDIA, of course, is the primary supplier of that today. And so I think that the demand outlook, looking out a couple years, is really, really strong. And I think NVIDIA stock is not priced for that strength.
Isn't there a risk, though, that we'll see cancellations of these some of these big data centers? People will have too much debt, for example, and that could cast a shadow over the sector?
There's no doubt that their customers are spending really aggressively to buy as many of NVIDIA's systems as they can. The Amazons of the world, Meta, Microsoft, Google, Oracle, they're all spending, pretty much all of their operating cash flow to build new data centers here in 2026. That aggregate spending amount is $600 billion or thereabouts. Just this morning, Applied Materials, which is a semiconductor capital equipment business, spoke at a conference, and they said they think that $600 billion number in 2026 is going to go to $700 billion in 2027. That growth, that's a high teens growth rate. those customers, those 4 or 5 big, CapEx spenders that I listed earlier, their cash flows are growing about, 15, 20, 25% a year. So that, $600 billion this year going to 700 next year seems reasonable to me. That is above where consensus estimates for capital expenditures sits today. And so I think that's why you see really all of those stocks I listed up here this morning.
Broadcom, another device maker you like the look of. Just remind us, where do they fit into the data center build out, please?
Yeah, sure. Broadcom helps a lot of these big CapEx spenders I listed make their own semiconductor chips. They're not as good as NVIDIA's. They're not as powerful. They also don't consume as much energy, and they're cheaper to purchase. The big CapEx spenders, the big data center operators, Amazon, Microsoft, Meta, Google, they want NVIDIA's super powerful top-of-the-line chips, but they also want a lesser version to handle the least demanding tasks. So Broadcom really is piggybacking on top of this growth in accelerated computing capacity and the big CapEx spending plans of those big data center builders. So I'm really participating in the growth alongside NVIDIA. I don't think of them as true competitors. I think they're more, everybody's growing, everybody's participating in their growth. It's not so much what's good for NVIDIA is bad for Broadcom or vice versa.
Right. So this is they enable companies to build their own devices and kind of get out of the grip of NVIDIA to some extent. They don't just go to that company.
Yeah, diversification and balance. It's not really an acceptable situation for Microsoft and Meta and Google and Microsoft to be so exceptionally dependent on one key supplier, NVIDIA in this case. They need other options. And the best second option is partnering with a Broadcom or Marvell to design their own less powerful chips.
We're awaiting the latest CapEx forecast for Microsoft. That's your final idea. What draws you to Microsoft right now?
Yeah, Microsoft stock has been beaten up because of this software sell-off that's been going on over the last 6 months. I think investors have been shooting first and asking questions later with regards to virtually all software stocks. Over the last 6 months, Microsoft has been caught up in that, even though yes, Microsoft offers a whole lot of software to customers, but they also have a really large cloud computing business and other businesses in their corporate umbrella. So I think Microsoft is an attractively valued stock today. I think their competitive position, both in software and cloud computing, are very strong. And so I think, we think that stock is an attractive candidate for purchase here today. Just one more mention, maybe. Oracle reports earnings tonight. They are going to give us a view on CapEx spending as well. They recently upgraded their capital expenditure forecast from $35 billion to $50. We might get another update to that here this evening.
People are a bit worried about Oracle, though, aren't they, in the debt load and whether they could be overdoing it?
Yeah, what's unique about Oracle, I mentioned that most of these companies are spending all of their operating cash flows to build data centers. Oracle's gone beyond that. They're spending more than all of their annual cash flows. They have a fairly high debt load, about 4 times EBITDA, and so they're the most kind of leveraged, the most aggressively financed of these data center builders. And investors are skeptical of that and concerned about it. There's so much about AI that's unprecedented and unknown. Sure. When you stack leverage on top of that, investors are worried.
And would you be a buyer of Oracle right now?
We own a small position of Oracle in our Argent Dividend Select strategy, but it's a small position for us.
And he was speaking with Jed Ellerbrook, portfolio manager at Argent Capital Management. We'll have more coming up after the break. Well, the federal government, along with the government of Ontario, will invest more than $228 million over the next 3 years to protect workers in key industries. Economic Development Minister Patty Hajdu says the investment will expand training and employment supports for those affected by U.S. tariffs and global trade disruptions. A wide range of workers will be eligible, including those laid off and workers seeking new skills. Shares of Fairfax Financial are edging higher. They're up about 1.4% right now. The company is selling off about half of its stake in Poseidon for about $1.9 billion US. Poseidon is the holding company for C-SPAN, which owns shipyards and ferries in the U.S. Pacific Northwest. Fairfax says part of the stake will be acquired by two new strategic partners. It will retain a 22% ownership in Poseidon. Sales growth at Taiwan semiconductor manufacturing rose only 30% in the first 2 months of 2026, missing analyst estimates for the current quarter. Analysts are also noting that TSMC's revenue may only reach the low end of its forecast, with the softness reflecting weaker smartphone and PC demand, with higher memory prices pressuring shipments. The company has been shifting capacity to make more high-end chips that go into data centers. And a quick look at the markets. They are in the green right now, liking what they heard from the president yesterday. And in fact, oil prices are dropping. You can see the TSX up by a full percentage point right now. And south of the border, also lots of green there. The S&P 500 up by 0.66, the Dow by 0.9, and the NASDAQ almost by 0.9 as well. Well, Canada is going to allow TikTok to continue operating in the country, a complete reversal after the government had ordered the social media company to close its Canadian division for security reasons. For more on this, we're turning to Bloomberg's Thomas Seal, who joins us now. Thomas, thanks very much for joining us. Give us a step-by-step on what happened from we didn't like them and now we like them again.
Yeah, it's quite a 180. We being Canada in this situation, Canada ordered TikTok to close its Canadian operations back in November 2024, right at the tail end of Justin Trudeau's tenure. They cited national security concerns and they gave them an order to wind up their businesses. That didn't mean the app was banned. People would still have been able to use TikTok, but they have offices with lots of people in Vancouver and Toronto. They would have had to shut those. TikTok obviously challenged that in court, and this was rumbling on in the courts. And then kind of abruptly in January, we got this filing that said that the government and the parties had agreed to basically set that whole thing aside, start a new review. That gave TikTok in Canada a reprieve. And then now we are, 6 weeks later, maybe 4 weeks later, this new review is already over, and they've found there's a way to keep it open after all. There's some security enhancements, and I think, an interesting piece of context here, I'm not saying it's, there's a causal link, but ByteDance is headquartered in China, and the order that sort of changed this process around came days after Mark Carney had visited China and met with Xi Jinping. And obviously there's been a lot of discussion about whether or not China has any relationship to ByteDance, which ByteDance says there's no government influence at all, and it's got a whole mix of investors from all over the world.
I was going to ask this. It was quite the about face. I mean, was there also the possibility that they might have the government might have lost in the courts on this one?
Yeah, that's a very interesting possibility, and we will never know now because that process has been ended. Maybe the government saw that coming. Ultimately, it was a national security order, so I'm sure they can defend quite a lot on those grounds. For instance, an interesting parallel being a Chinese origin technology firm, Huawei, was obviously being used quite widely and then was banned. So maybe they could have gone down that route, but in the end, it turns out TikTok says 16 million Canadians use the app, which is more than a third of the country, and so they will be able to continue using that. And what's more, the operations in the country mean that TikTok can do things that are specific to Canada, cultural, support and sponsoring events and so on.
And a very different approach than what happened in the U.S. I wonder what kind of reaction we'll get from the U.S. on this.
Yeah, it's interesting. Obviously, the US had been more hawkish on TikTok earlier. So under Trump 1.0, in his first term, he had sort of, as I think, suggested that he wanted to, restrict the app or even ban it. Then we had Joe Biden kind of continued that strain of thought, and there was legislation that forced TikTok to either sell or be banned. And Trump had sort of repeatedly delayed that. I think he saw that TikTok actually may have helped him spread his message during the election campaigns. And now Trump, this deal has finally been signed. So there's now a TikTok US sort of side entity, which is got US managing investors, and that's now like a splinter company compared to the main TikTok.
And then for TikTokers, I believe that's the term, right? They're TikTokers. What are the benefits are there benefits for the Canadian TikTokers?
So TikTok points to things it does, like around elections, for instance. Canada has 2 official languages and other sort of more cultural specificities. They are now going to be able to, provide better support for things like that. They sponsor events and sort of foster creators who are kind of up and coming on the platform. I think they sponsored the Juno Awards. So things like that, all that kind of Canada specific stuff, they were saying was put in jeopardy by this order, which has now been rescinded.
All right, we'll have to wrap it up there. But one last question, Thomas: are you on TikTok?
It's too addictive for me.
I posted once when it first started, and that was it. Okay, Thomas, thanks very much for that update. We appreciate it.
Thank you.
Bloomberg's Thomas Seal. Coming up, G7 energy ministers met today to discuss the possibility of releasing oil reserves. We'll talk about the market implications of that after the break. Oil prices are in retreat today after U.S. President Donald Trump said the war could end soon. Now, despite this, G7 energy ministers have been in talks to potentially release oil reserves. Here to break down the oil supply outlook is Matt Smith, lead oil analyst at Kepler. And Matt, thanks very much for joining us.
Thanks for having me.
So the G7, are they playing pass the buck today, saying, "Hey, let's have the IEA take a look at this"?
I know it's interesting in itself, right? Just talking about doing some type of release. Now, we are all concerned about how long the Strait of Hormuz is going to be open. Could it be open another 1, 2, 3 weeks? Potentially, yes. But by the time you get some type of release done from the strategic reserves, the physical impact of that is going to take beyond that period, right? And so if it's the IEA or it's G7, whoever looks to make an announcement to release these reserves, it's going to have an impact on sentiment straight away. It's going to weigh on oil prices, but the actual physical impact of it is going to take weeks. And hopefully by that point, the Strait of Hormuz situation will be going some way to being resolved.
So could they, in theory, say, hey, we're going to do that, and then because everything gets resolved, they don't need to worry about releasing any of the reserves and they get to keep them?
Would
they be locked into having to release some?
I guess they would have to meet again to say, you know what, we're actually backpedaling on this. It's possible. But I don't know. Someone like Japan, I think it's very important to talk about this. When you talk about G7, Japan is absolutely key out of all those players in terms of how much Middle East crude it gets, right? It takes about 2 million barrels a day through the Middle East Gulf, through the Strait of Hormuz there. That is 90% of its total imports. And so Japan, more than anybody here, is key to look for these barrels to be released. Everybody else, all of these different countries are taking crude. Everyone is so reliant upon the Middle East, right? But they are potentially looking at this as more of a way to ease prices lower as opposed to them getting their hands on this supply.
And does the fact the oil prices, it's plunging today, really? I mean, after that wild ride up on it was only yesterday. After that wild ride up, it's now back down to $80. Is that going to be a factor with the G7 and with the IEA?
I think we're just in this absolute volatile time now, right? And so we're moving on headlines. There's talk, there's potentially a U.S. tanker that has been able to get through the Strait of Hormuz with an envoy. That's why we're apparently dropping right at this moment. I saw that like a minute before we came on here. But we're just moving so much on headlines here that I think the broader picture here is we have to take a step back, look at the Strait of Hormuz, see how much passes through there and see how much has been halted, and look at this realistically and say, look, this situation, even if it was resolved right now, is going to take time for these barrels to come back through the market, get past and through this choke point. And so, even if it was resolved today, it's still going to take time, let alone if it goes on for 1, 2, 3 weeks from here.
And Saudi Arabia, they're trying to shift oil to go north. Is that just precautionary, or is that a sign of things to come?
You know what? It's for one of two reasons, it seems, right? So one is there's just ultimate caution, but really it looks as if they're doing it because they're concerned this is going to go on for weeks here. And the reason I say that is because we're looking at these future arrivals of these tankers, and they are scheduled up until the end of March into April here. And so what is happening is you have an east-west pipeline that takes the crude from being in the Mideast Gulf, where they typically load from, across to Yanbu in the Red Sea there. And so typically we don't see more than 750,000 barrels a day being exported from Yanbu. But now we're up over a couple of million barrels per day, and we're looking at getting up to over 4 million barrels a day for this month. And so that suggests that Saudi Arabia thinks this is a longer-term problem and not a quick fix.
And what's kind of faded over the last few days is the natural gas. What's going on with that right now?
The problem is still there, right? So you have Qatar that exports 20% of the world's liquefied natural gas. That isn't leaving. They have had to shut down production. They have also released that it's going to take a good number of weeks for them to ramp back up again. So that natural gas issue is not going to be going away anytime soon. That Qatari natural gas does not go into Europe. However, you are seeing cargoes being diverted from the US away from Europe to Asia because there's simply that pull, because Asia is now missing 20% of LNG flows from the global market.
And are there other providers that can make up for that 20%, or is it vital?
It's vital. So the US has basically become the swing supplier now. You have like 3 players, Australia, Qatar, and the US, which account for 60%, something like that, of all global exports. Australia is already sending to Asia, so therefore the US becomes the swing supplier. And because of that, Europe is price is so high because it wants to hold on to that LNG. That is the concern, whereas Asia is bidding it up to take it away from them.
And then I guess the one other kind of wild card, we heard Trump talking about Russia being allowed to do some deliveries possibly to India. What does that mean?
India needs it more than most people, right? And so when you look at India imports about 5 million barrels a day. Half of that comes from the Mideast Gulf through the Strait of Hormuz. India also has very little in onshore storage. And so it has about 100 million barrels, which is 20 days cover. That is super small. And so the Indians are basically panicking here. And so the ability for them to be able to buy Russian crude now, whether it's on a waiver for 30 days or otherwise, is a huge boon to them. That said, that isn't going to fulfill the full gap that is being left by the loss of the Middle East barrels going in there.
Okay, Matt, we'll wrap it up there, but thank you very much for joining us.
Appreciate it. Thank you.
Matt Smith is the lead oil analyst at Kepler. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Your Options is back. Tune in Wednesday at 3 p.m. to have 3 p.m. Eastern, of course, to have all of your options trading questions answered by Chris Tom of Moat Financial. You can send us your questions to knowyouroptions at bnnbloomberg.ca. All right, let's take a look at some of the movers south of the border. And for that, we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always for joining us. Coal's turning things around. Sort of. When we say sort of. Well, I mean, it's better. How's that?
You know, Roger, the interesting thing here is I would say that we've seen a positive stock reaction today, even though analysts on Wall Street have had a pretty downbeat reaction to the report that the company gave. So just to walk you through some of the trading here, the company reported earnings this morning. Their comparable sales fell 2.8% in the most recent quarter. That's about twice as large of a decline as Wall Street was expecting. So you saw the shares falling in pre-market trading, but then jumping earlier today as much as 15%. And everyone's just kind of looking to sort through what happened here. Our colleagues over at Bloomberg Intelligence say there might have been a bit of a short squeeze going on. So stock starts to move up a little bit and short sellers have to buy shares to cover their position. That drives the stock up even more. Now it's settled down a little bit, up less than 2%. But again, I would say the reaction on Wall Street has been muted to negative. Jeffrey says you're seeing signs here that they're struggling to compete in the really critical holiday season. They're also saying they see the U.S. consumer, especially low to middle income consumer, under pressure.
I think a lot of retailers are feeling that and saying that, aren't they? It looks like it might be a tough year for some of them.
Yes, absolutely. I mean, you and I have talked about this a lot. This remains the key question for retailers. And now you've got, stocks like Gap, for example, selling off due to tariffs, due to the war in the Middle East, lots of things that could hit demand or raise prices.
All right. Centene made some comments that aren't sitting well.
Yes, Centene said at an industry conference that they expect really steep declines in Affordable Care Act enrollment. This is a health insurance company, and the Affordable Care Act is a huge part of their business, even compared to peer companies. They expect about a 35% decline across the industry after U.S. healthcare subsidies, or some subsidies, I should say, expired at the beginning of the year, and even steeper declines for them. That's really weighing on sentiment today. Shares down about 13%. They're also seeing some signs of customers using more expensive treatments. That drives up costs. You'll remember that standoff over government subsidies for healthcare was what shut the government down for a record period of time here in the U.S. near the end of last year, and now we're starting to see that show up in some company financials.
All right, last one. American Airlines. We know the airline industry is it's cyclical. Can we call it that? And it has and can react to things that happen around the world, which is happening right now, isn't it?
Absolutely. And another one you and I have talked about a few times recently. Airlines heavily exposed both to the health of the economy and to the price of oil and jet fuel. The war in the Middle East has threatened to hurt the economy and raise fuel prices. You've seen here in New York the price of jet fuel jump about 55% since the conflict began. And now, even as oil is plunging today, airline stocks are once again lower. I would say that might be an example of investors turning their attention just from the commodity prices to the effect on earnings. Wall Street firms have been consistently sounding the alarm. You saw a downgrade of American at Rothschild & Co. Redburn last week. They see the airline losing money this year now as a result of the conflict.
And I imagine, they're looking at some of the jobs numbers and wondering what people, are they going to scale back travel, things like that. It's a tough industry.
Absolutely. It's been a theme that I've been exploring with investors. You've got just a lot of uncertainty swirling around this market, not just the war, but questions about the strength of the labor market, inflation, and of course the war piles on to those concerns as well.
Okay, we'll wrap it up there, Matt. Always a pleasure to talk with you, sir.
Thanks for having me, Roger.
Bloomberg's Matthew Griffin. Let's take a look at the markets before we go and some stocks to watch. But first up, just the overall. Lots of green everywhere right now. People feeling a little more relieved after the comments made by the president yesterday that the war may be wrapping up. Of course, then we heard Hegseth, the Secretary of War, saying, well, this is going to be the heaviest bombing day that we have seen, or one of the worst. So it's hard to figure out what's right and what's next. But right now, the markets seem happy with what they're seeing. TSX up 0.83, the S&P 500 0.56, and the NASDAQ by 0.73. Now, some stocks to watch. Go easy, not having an easy day at all right now. It's now off by 65%. It's just been diving all day. It had recovered slightly. It's on its earnings. It had changed a whole bunch of things in it is now paying the price for that. I'm just trying to pull it up for a second here on what happened to it. And it bounced back. It pulled back on its reports. Had higher losses than planned. It suspended its dividend, withdrew its financial outlook, disclosed hundreds of millions of dollars in loan losses as well. Now going the other way, there we go. There's Go Easy. It's still down 65. Let's pull up Denison Mines, see where they're at right now. And they're having a good day. They're up about 6.5%. No real clear way for the reason why on that, but they're up 6.5% just to have one of the movers. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thanks very much for joining us.